Hello everyone, this is Mr. Stocky. We are making this presentation at the end of July. First, a disclaimer. What you'll hear in this presentation are my own opinions. Please do not take any of this as financial advice. It's meant for educational purposes only. Okay, so one of the more difficult aspects of the eToro platform is trying to get a detailed understanding behind a popular investor's strategy, and in particular, its behavior or its expected behavior in varying market conditions. Many of the top performers this year are short-term traders like myself who haven't been on the platform for very long. Most of us have pretty short track records to look back upon, and therefore it is difficult to analyze how our strategies might behave in different market conditions than those that we have experienced this year. If we look at the elite investors or popular investors on the eToro platform, they tend to be long only growth, dividend, or value type of investors. And I think generally most people are quite comfortable and understanding of the sort of behaviors you would expect from those type of strategies. When it comes to short-term traders like myself, we are all different. Our use of leverage, our use of technical and our insights may mean that although we might look very consistent in terms of our returns in this current environment, the bigger question that I think copiers need to understand and need to be aware of is how our strategies might behave in varying market conditions other than those of this year. So this is the main crux of the presentation that I want to share with you, is to focus on how my strategy in particular should behave or is expected to behave in varying market conditions. And how I would like to do this is to give you an illustration of this behavior by going back in time using simulated results. So just before we go into detail about those behaviors of my strategy, if you haven't done so, please do check out my eToro homepage. There you'll find some detailed information about my background, and more importantly, a lot of background information in terms of my strategy, my objectives for the strategy, and what you should expect from the strategy going forward. There's also a Q&A section for some of the more popular questions. So please do read that to get a good grounding and a background of what I do and what my strategy is all about. So let's get into it. I wrote a post about 1 or 2 weeks ago about this particular subject of behavior, of strategy behavior. And the data I used for this was the returns of the S&P 500, or the hypothetical returns of my strategy of just trading the S&P 500 stock index. And the data I used goes back over 10 years, as you can see. And there you can see a range of returns throughout the years. Now, what I want to focus on is not the quantum of the returns, but rather the variability of the returns due to varying market environments. And I think you would agree that over the last 10 years, there has been a good range of market environments where we can use to get a good understanding of expected behaviors and specifically of how my strategy might behave in those market conditions. How I want to go about doing this is to go through some examples and illustrations of 3 particular years I've chosen. The first one is the year 2020, which is the COVID year, where markets experience strong volatility and trending markets. And as you can see, that was a particularly strong returning year for my strategy, at least the backtested simulator results. In 2017, we had the contrasting environment where it was very low volatility. There was a lot of choppy markets. And as you can see, relative to both the market and absolute terms, our returns were a bit lower compared to other years. And finally, I've chosen the year 2012 as a normal or average year that we should expect and how the strategy should behave in those sort of environments where there's a mix of choppy and volatility, choppy markets and high volatility environments. So let's jump to year 2020. This is the chart of the S&P 500 over that year. You can see during COVID, we experienced a big V-shaped movement in equity prices. Firstly, the big down leg of almost 36%, and then the V-shaped recovery during the second or the second quarter of the year, and an amazing 64% return on that recovery. Followed by that, to end the year, we had some choppy markets and then a low volatility environment. So in terms of the illustrated or simulated returns, we returned about 47% on that year. So it was an outstanding year, probably what I would call an out of sample year, not something we would expect on any typical year. But these do happen from time to time, so we should study the behavior of the strategy in these type of volatile environments. So what you should expect from my strategy is that I will be able to capture a big chunk of these very large, fast trending markets. I probably would not catch the first 1/3 or the final 1/3 of that particular move, but certainly you should expect that I can capture the middle of the move, and if we're lucky, maybe 1/3 or 2/3 of that big move. And indeed, we did do so in 2020. So we caught the good chunk of the first down leg during the February-March period. And on the reverse, on the way up, we also captured a lot of the returns from April up to September. Now, one of the more difficult situations, and we'll go through this in a bit more detail later, is that the strategy does tend to underperform during choppy market environments. But there are particular type of choppy environments where it is particularly difficult. For example, in terms of where I've highlighted in the yellow circle there, you can see that there was some volatility moves, some gapping action in the prices of the index. And these sharp drops and up movements tend to be difficult for the strategy in that we're getting whipsawed in and out of position. So imagine that in early June we are positioned for the prices to continue to move up, and then suddenly during the second week of June we had that big sharp gap downwards in the price. Now that might either cut our profits, or in the worst case scenario, it might actually put us in a loss position and we have to exit that position given by the exit signals of the strategy. Where choppy markets may not be so bad for our strategy would be where you see the blue zigzag lines in October. So this type of choppy range market is quite expensive in that the up and down peak to troughs are quite large in size. So that does give us the opportunity to stay on the trend for a bit longer and capture a good portion of that move up and down. Whereas if we get very narrow range bound markets, which we'll see later, it becomes a bit more difficult. So overall 2020, we would have made a lot of our profits based on the first half of the year due to that V-shaped volatility spike in market movements. We would have done okay during the choppy period in October, and we would have done okay also in the less volatile, less choppy environment towards the end of the year. So overall, very strong year for the strategy, and I think strongly outperformed the S&P 500 on that particular year. Let's move on to a contrasting year and a much more difficult year for the strategy. So 2017 is an example of a more difficult type of environment for our strategy. The reason being is that for the majority of the year, it was a very low volatility environment. And for us to make a significant amount of profits, we need markets to move either up or down in a volatile fashion. And the more it moves in one direction, the longer it goes, the more profits we tend to make. So in 2017, as you can see, the markets were very positive. I think up almost 20% for that particular year. But the behavior of the market was such that it was a very low volatility year. As you can see, the zigzag that I highlighted compared to the previous year in 2020 is much more choppy. The zigzags or the size of the amplitude of the chops are very narrow. So what that means is that if we are positioned for an up move or down move, we may be able to ride that for a few days before it suddenly reverses against us, and we either have to exit that position, uh, losing the profits that we've made, or worst of all, actually being forced out of the market by our signals and exiting at a loss. And so overall, we return around 5 to 6% for that year versus the market that went up 20. So you can see there's a market difference in the outperformance of the S&P over that year over our strategy. And that's really because of that choppy environment. I believe during that environment in the simulated results, we were pretty much flat or to slightly negative for that whole period. So we didn't lose a lot of money because the risk management kicked in to kick us out of our positions. But we didn't make money throughout that period. We made some money during the first part of the year where there was a trend up, and also towards the end of the year during October to December where there was also some less volatile but moving markets. These very smooth type of market environments can also be a bit tricky for our strategy because any spike up or down within that low volatility environment can affect both our entries and our exit signals and can either force us to exit too early, or after we enter, we then find ourselves having to reverse that very quickly as the volatility diminished and the price reverses on itself. So that kind of environment can be very difficult for this strategy. Now let's go to a typical year that we might expect. And the example that I've chosen is 2012. I could have chosen a whole range of market environments because usually, as we expect, we should get a mixture of different volatility environments throughout an average year. And as you can see, this year indeed was one of those very average type of market environments. We had some strong trends, up and down, then a lot of choppiness, and this type of environment overall is generally friendly to our strategy. So as you can see for this year, the S&P 500 returned 13% for a long-term buy and hold investor, and we also returned around the same, and I think a little bit more than the market, but generally kept pace with the market. So in the first quarter of the year, there was a strong uptrend, which we would capture a majority of that, followed by the downtrend. And then towards the end of the year, in October to the end of the year, again, we had this similar repeat of the first quarter of the year. Where it got a bit difficult, although short-lived, would have been the choppy environment in the middle of the year. As you can see, the choppy market saw whipsawing action. And here you actually see that it was a quite difficult environment in that the choppy movements were very, very quick. So as soon as we got into a position, then as the market reversed, we had to get out of our position, and in most cases we would probably get out at a loss, given that the market reversed on itself very quickly just within a few days of itself. So to have a look at this year, 2022, what's this year been like for most investors? And obviously, we are still in a bear market at the moment, although we've had a big recovery in the last month or so. The S&P was down at 20%, 24%, sorry, at the uh, June lows, and currently we're trading around 15% year to date down. And this year, again, we could argue is a uh, volatile year, definitely, but also because of the large swings down, we could also say it's an out of sample year, as we wouldn't expect this type of environment every single year going forward. So the big swings up and down are typically good for our strategy. We would be able to capture most of the ups and down swings. In between, we saw some choppy behavior that were very similar to the 2012 example, where we had large, fast-moving, choppy markets. And that is a difficult environment because, as I mentioned, once we get a signal to enter, it moves up very quickly, giving us very quick profits. But at the same time, it also reverses very quickly in a short space of time. And if we haven't been given an exit signal, we would be losing a significant amount of our profit as we exit, or even in the worst case scenario, be on the losing end of that particular trade. What I didn't mention in the previous examples are periods where we might miss a big chunk of the move. And that can happen because the move may start off as a very low conviction uh, signal. What I mean by that is we tend to use a very small amount of our risk capital at that particular low conviction signal. And if the market does move in our favor, then we tend to exit out of that due to its low conviction nature. And if indeed that low conviction movement did actually um, become a bigger movement, then we would have missed out on the remainder of that movement. So the example of that was in June on that final leg down to the yearly lows. So we caught the very beginning of that and of that down move and we took profit. But as we didn't get an opportunity to get back into that final downward move as markets um, basically gapped uh, low very quickly, and unfortunately we were not able to participate in that big move to the downside. So in the June return, you would have seen we actually lost, um, was unprofitable for that month, just under, I think, 0.2% for that particular month. If we had better luck, we would have captured a much bigger piece of that move and would have made uh, a bit more money during that month. But having said that, so far this year, we're around 15-16% up for the year. So overall, I think we've done a really good job in managing both of the risk management side of things and also be able to capture a big piece of the movements so that um, with these big volatility movements, we've been able to generate a pretty good return for the year so far. So that brings us to the end of the presentation, and I hope this presentation was a valuable one in terms of providing you with a bit more in-depth understanding of how my strategy should behave or expected to behave in varying market conditions. My track record on eToro is really just over 6 months old, and of course we've only been able to generate that return in this bear volatile environment. So I want to share with you what we should expect from the strategy in many different scenarios, from the more difficult type of environments and also to even more favorable environments than the ones we have so far experienced this year. So thank you very much for taking time to listen to this presentation. What I want to leave with you is my goal and objective for the years ahead, and that is simply to provide a sensible and consistent return to copiers.